What's up, everyone? My name is Ale. Welcome back to my world of stocks. We are, of course, well on our way into 2024, and I thought it'd be a fun idea to take a look at Warren Buffett's stock portfolio because at 93 years of age, let's be honest, our time with Buffett is unfortunately very limited at this point. So we might as well enjoy looking at his different stock choices while we still can. Now, at over $1 trillion of assets under management, Berkshire Hathaway is still one of the largest holding companies in the entire world, with currently over $300 billion worth of just stocks. And yes, even at 93 years of age, Buffett is still somehow the acting CEO with a leadership position on that portfolio. And I don't know how he does it, guys, but it is very impressive to still be doing all of this work even at that age. Anyway, the portfolio itself holds around 50 public stocks, which there's really no way that I can cover all of those different stocks in just a short YouTube video. However, the 10 largest of those make up over 80% of the portfolio, with all the remaining stocks only being worth less than 1% each. So I think as long as we cover at least the 10 largest, I think we'll have a pretty good idea here of what this portfolio mostly entails and what it looks like going into the future. Now, a couple of quick notes on this though. Buffett has been investing, of course, on most of these companies for many years, decades really, and that does play a role into why he holds these type of stocks and holds them for so long, even though they're not the most exciting companies out there. He may just have a really good base price on some of these stocks, maybe collecting some great dividends, and those types of things can make these much more attractive to hold on to long term. Also, keep in mind that this is, of course, a very massive company with giant amounts of money, so wealth preservation is also likely going to be playing a big role here as well, where he's going to be more inclined to be choosing already large, safer, well-established companies that he can kind of park his money in rather than higher risk growth stocks that you have to take a bit of a chance on. Regardless of any of that though, I'll be giving you my own quick opinion on each of these stocks, and I'll even rank them from best to worst as well, which is something that we like to do a lot here on the channel. It's a lot of fun, and I hope you enjoy it too. If you are enjoying the channel, please subscribe. It really helps me out a lot. If you want to go above and beyond, you can support me on Patreon. Link is in the description, or by hitting that join button here on YouTube. It means the world to me. Thank you so much to everyone that is supporting me that way too. It helps keep the channel alive. But with all of that said, let's go ahead and jump into these 10 largest stocks here that Warren Buffett is invested in. All right, now we'll be counting up here from smallest to largest, and stock number 10 is going to be VeriSign, ticker symbol VRSN, which is the only stock on the list to actually sit below 1% of the portfolio, but it's still worth over $2 billion, so it just shows you how really massive this portfolio is. Anyway, VeriSign is actually a stock that I've been researching more recently myself, and I'm actually thinking about buying some of it too, because the business is very attractive. What they do is really provide domain registry for certain top level domains like .com and .net and other things like that to paying customers for an annual fee. And then they act like the sort of infrastructure for them, making sure that these domains are always up and running, which VeriSign has done a great job of with over 25 years of uninterrupted service. And because they have an exclusive agreement with the Internet Corporation of Assigning Names and Numbers, which is a nonprofit governing body of the internet, well, VeriSign has been able to benefit from a sort of monopoly over these specific domain types. And so as the internet grows larger with more web pages popping up every day, so too have VeriSign's revenues increased, especially during the pandemic. Profits can be a little shakier than that, but are also very strong and solid, and overall the company still manages to grow both sales and profits by around a mid to high single-digit percentage in most years and going forward as well. And while the stock price has risen over the past decade, as you would expect, a recent dip coming off the pandemic has actually left it below the midpoint of its 52-week range, with also a valuation that isn't all that bad either, hovering just a bit above the sector median. I'm currently hoping for a bigger dip myself before jumping in, but overall, I think VeriSign is absolutely solid, and I'm ranking it pretty high at number 3 for now until I see what else is on this list, because I do really like it. Moving on to stock number 9 though, that's going to be DaVita, ticker symbol DVA, at just over 1% of the portfolio and also worth over $3 billion. And what this is really a healthcare type of company that mostly specializes in kidney care, helping with transplants, at home or in-center dialysis treatments, and even nursing facilities. In all, DaVita now serves over 200,000 patients at over 3,000 dialysis centers across 11 different countries. And the reason why Buffett likes this one is pretty simple. This is an already well-established business that is relied on by thousands of people for widespread illnesses related to kidney disease that is not likely to disappear, and definitely not anytime soon, as our giant aging populations will only need more care for this over time. In fact, according to the US Census, the entire baby boomer generation will be turning at least 65 years of age by 2030, which is a decent tailwind for them to rely on. Still, the company is a bit too boring and low growth for the type of investor that I am myself, as both sales and profits are always sitting about flat in most years, and even when they do grow, it's at a low single-digit percentage at best. The stock itself is extremely cheap compared to the sector, but it was also trending pretty negatively up until the pandemic hit, so I'm not sure how much I trust it going forward. It's probably a decent enough stock for most investors, but like I said, I'd rather invest in something more exciting, and because of that, I'm going to put it around the middle for now at number 5. I'd probably be more interested in it if they at least paid a dividend. Moving on to stock number 8 though, that's going to be our first finance company in Moody's, ticker symbol MCO, at almost 2.5% of the portfolio, which is a business and financial services firm that is really famous for being one of those top 3 major credit rating agencies that you've probably seen before on your own credit report or something similar to that. But of course, they offer all kinds of other services too, helping both governments and corporations with many different finance and credit related services. Some examples of their work include helping a wind turbine manufacturer obtain a credit rating on its bond issuance, a bank evaluate the credit risk profile of a small business owner, an insurance company automate capital calculations, a real estate firm research their next investment, and a car manufacturer better understand the risk profile of its footprint and supply chain. In all, Moody's has become so entrenched in these various financial markets that they've now rated over $72 trillion of debt, processed over 200 million financial statements representing over 40 million private firms, and hold over 400 million companies in their private company database. In other words, you probably won't see Moody's disappear anytime soon, as they are just too heavily relied on by these other major institutions, which is generating them billions of dollars on both sales and profits every single year. As you would expect though, they are heavily tied to the macro economy, which is why they saw a big drop off in 2022. And while they are already recovering by close to a double-digit percentage in growth, I'm a little worried about how expensive the stock is in relation to also how shaky I believe the economy still is, with a stock price that is already up over 150% in the past 5 years, leaving it hundreds of percents more expensive than the sector. And I'm sorry, but as high growth as their dividend is, that yield of only less than 1% is nowhere near high enough to convince me to buy into this stock at this price. I'm not saying it's a bad stock, but I just think it's a bit overvalued at these levels, so I'm ranking it pretty low at number 7, as I also just find the business to be a little boring with not much to really offer me at today's high price. Up next though, we have stock number 7 in the food giant Kraft Heinz, ticker symbol KHC, at over $10 billion and worth about 3.5% of the portfolio. Now you guys know this one. They're famous for their popular food brands like obviously Kraft cheese and Heinz ketchup, but also Oscar Mayer meats, Capri Sun juices, Jell-O, Kool-Aid, Weight Watchers, Philadelphia cream cheese, Lunchables, and many more. As popular as those brands have always been though, I'm just not the biggest fan of this company because of their lack of growth and innovation. On top of that, I think the world will slowly become more aware of just how how unhealthy many of these brands are, whereas I see much more growth opportunity in new trends like the ketogenic diet and other low sugar or low carb alternatives, different types of healthier diets. Not to mention cheaper store brand alternatives that also make it harder to grow in such a crowded market. I do think that they'll survive and still make strategic acquisitions whenever they can to fuel at least some future growth, like they did in, for example, acquiring Primal Kitchen a while back. But overall, I just don't think that this is anywhere near the same great company that they once were. With today's performance usually seeing their financials about flat at best, with another revenue decline expected in fiscal 2023 of about 8%, and then still about flat the year after as well. Sure, the stock price is already down about 20% in the past 5 years, leaving a cheap valuation and pretty high dividend, but that dividend has been cut in the past, and if the company can't even grow during these pandemic and inflationary fueled years of more people stocking up at higher prices, then I'm not really sure what it will take for them to experience a tailwind in the future. I think it'll survive and probably be fine long term, but I'm looking for better performance than this, so it's taking the lowest ranking for now at number 8. Alright, now as much as I don't like Kraft Heinz, I actually think stock number 6 has a ton of potential, and that is the oil and gas giant Chevron, ticker symbol CVX, at almost 6% of the portfolio and worth over $18 billion. Now, before you guys kill me in the comment section, I totally understand that this is a legacy oil company when all the growth will likely come from renewables over the longer term. But I just think that Chevron is a bit of an exception here that can actually use their huge profits from oil to continuously invest in renewables at the same time and really end up controlling big market share in virtually all parts of the gigantic energy market long term. For example, they've already acquired the world's largest hydrogen storage plant with a majority stake in the ACES project that will use hydrogen to produce electricity, the first project of which will produce up to 100 metric tons of hydrogen per day and store it in underground salt caverns until it's needed to supplement wind and solar, which can sometimes be unreliable. And because hydrogen is so important for stabilizing the renewables market, analysts project it to become a $1.4 trillion market opportunity by 2050. That's huge. But Chevron isn't stopping there. They're also investing in BioBen, which is one of the largest carbon storage projects in the country, which is another market that could be worth trillions of dollars, by the way, in the future. But they also acquired Renewable Energy Group for over $3 billion, and they're planning to invest $10 billion through 2028 on even more projects too. Add it all up, and I think Chevron will be a force to be reckoned with in virtually all energy areas. The only thing that is holding me back from buying it, though, is the post-pandemic run-up in stock price that was fueled by several conflicts around the world that sent oil prices skyrocketing, which more than doubled Chevron's revenue to a gigantic $235 billion last reported year. But because of that, a correction is now needed, which is causing their sales to fall by over 20% in fiscal 2023 and still being about flat in 2024. I'm not too worried about that though, as their sales will still be extremely high, and the stock price did dip a little to reflect that too, now sitting around the bottom of its 52-week range. But I'm just saying that it could be cheaper and more attractive than where it sits right now at about 20% more expensive than the sector. Still, I think the business is really streamlined for the future, and getting to collect a great dividend above 4% with a low payout ratio and over 3 decades of consecutive growth while you wait for those future growth initiatives to take shape, I think it makes it all the more sweeter. I'm actually tempted to buy a little bit of this stock myself, but I think I might hold out for just a bit longer to see if I can get the price a little lower. Either way though, I'm ranking it pretty high at number 3, and I'm going to push VeriSign up one spot to fit it in, just because I like VeriSign a little bit more for the cheaper valuation. Alright guys, we're now breaking into the top 5 largest here. So these are all the big dogs here, and coming in at stock number 5, we have another oil and gas giant in Occidental Petroleum, ticker symbol OXY, which makes up over 6% of the portfolio and is worth almost $20 billion. In my opinion though, this one is nowhere near as attractive as Chevron, because First of all, their investments into renewables are much smaller by comparison, and overall, I just feel like Buffett mostly owns it for the preferred stock and special dividend that he got in exchange for helping them acquire Anadarko back in 2019, which after cutting their dividend in 2020, Buffett actually got to keep his really high dividend regardless. But for the rest of us, that yield is only around 1% now. Add that to the volatile financials, the volatile stock price, and the rich valuation, which is even higher than Chevron, and this relatively weak performing stock just has almost nothing for me. So I'm putting it in last place at number 10. Coming in as the fourth largest stock though, we have a dividend king in the almighty Coca-Cola, ticker symbol KO, at over 7% of the portfolio and worth over $22 billion. As most of you know though, KO is mostly a slow-moving, dependable kind of dividend stock that won't get you huge gains, but will at least contribute about 3% or so to the dividends portion of your portfolio, with over 6 decades of consecutive growth on it, thanks to strong brands like the namesake Coca-Cola, as well as Powerade, Sprite, Minute Maid, and many more. However, the stock is significantly more expensive than the sector, and I just feel that PepsiCo offers much more diversification thanks to their solid food snacks business as well, with also about the same dividends. So I'd much rather invest there instead. I totally understand why many people hold Coca-Cola stock as a dependable, kind of dividend king stock, but I just think that there's much better options out there. So KO will get the number 6 ranking from me. Alright guys, we're breaking into the top 3 now, and coming in as the third largest stock here, that's going to be the credit card giant American Express, ticker symbol AXP, which I believe Buffett has owned for a really long time. I think it's been since like the 60s, and it's now worth over $22 billion and over 7% of his portfolio. As far as the business goes though, they're of course famous for their credit cards, where as a network, they hold the third largest market share by purchase volume, only behind Visa and MasterCard, where they're able to collect fees on any purchases that are ran through their network. However, what sets American Express apart is that they're also a credit card issuer like other banks, which means they also hold loans and get to collect interest on those balances, where they even have the second most market share by both purchase volume and outstanding balance, only behind Chase. And while this does make it a bit of a riskier stock during economic downturns because people can default on these balances, well, I think AXP has at least done a pretty good job of building up a strong brand that they use to primarily target higher income customers with better credit. The results being record sales last year, with still expected growth of around a double-digit percentage going forward. Overall, it's a very strong business, but there's one main reason why I don't buy in, and that's how expensive the stock price has become, because after soaring in recent years, the valuation is significantly more expensive than the sector, while the dividend yield is also tiny at just around 1%. I'm sorry, but from a network perspective, I prefer the larger Visa. And from a bank perspective, if I'm taking on that added risk, I'd prefer something with a cheaper valuation and bigger dividend, like Chase or US Bancorp, for example. So it's getting the number 5 ranking from me. I like it, but not as much as maybe some others. And it's going to replace DaVita, which I will bump up 1 spot to fit it in. Speaking of banks though, coming in at stock number 2 is Bank of America, ticker symbol BAC, at just over 9%. And because we're running low on time here, I'm just going to make this one very simple for you guys. I prefer Chase and US Bancorp much more, as Chase has the larger size and safety, at least in my opinion. Both it and US Bancorp have the better return on equity, and US Bancorp also has the bigger dividend as well. So while I think that Bank of America could be an okay alternative, I just can't really envision owning it myself, and for that reason, I'm putting it pretty low here at number 6, just barely behind American Express, and I'll move the others down 1 spot to fit it in. Alright guys, that's going to leave us now though with the final stock of the list, and no surprise here, stock number 1 is going to be his biggest tech darling in Apple, ticker symbol AAPL, which, check this out guys, it makes up over half of his entire portfolio. How crazy is that? One single stock at over 50%, and it's worth over $156 billion. It's pretty crazy. Now, the reason for that is pretty simple, as Apple is not only the largest company in the entire world by market cap, but it also has an equally large and impressive business with a very sticky ecosystem of products and services that people stay hooked on, with over 2 billion active devices currently in circulation. As a result, Apple is able to generate mind-blowing financials, doing close to $400 and $100 billion of sales and profits respectively per year. Not to mention the giant cash pile that they're sitting on of over $160 billion of cash as well, that ensures they can invest in any future growth initiatives that they want. I personally own a small position in Apple, and I think it's fine for anyone else to own some of it too, but at its currently high price tag, trading a bit more expensive than the sector with limited growth on the horizon because of their already massive size, I'm just not sure it's as good as maybe something that is a bit more diversified with more growth opportunity, like maybe Google, Amazon, or even Microsoft. It's still one of the best stocks on this list though, so I'm going to give it the number one ranking just because it can really fit into pretty much anyone's portfolio, and certainly it fits much easier than most of the other options on this list. But there you have it, guys. What do you all think about my overall ranking here? Would you make any changes to it, or are you invested in any of these stocks yourself? Personally, I do like Apple, I like Chevron, and I like VeriSign. Those three I like the most here. They are, of course, a bit expensive. I would like them to be a little bit cheaper, but I think long term, those are pretty solid stocks there. The rest of it, though, it's a bit boring. It's more of like wealth preservation types of stocks that I don't usually care too much about. I'm usually more interested in more exciting companies with more future potential. But hey, that's just me. I'd love to hear your thoughts down below. We can all have our own disagreements and opinions. I'd love to hear what yours is. So let me know down there in the comment section. But thanks again for stopping by, my friends. I hope you all enjoyed the video, and I hope you're all doing well. And I will catch you in the next one. All right, take care, everybody. Bye-bye.